Okay. All right. Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Properties. On this episode, we will be talking with Shane Carter, the president and CEO of Hampshire Capital. Shane has over 24 years of active real estate experience, which includes new developments, property repositioning from apartment buildings to commercial assets, including land. Shane has acquired and renovated and managed more than $215 million worth of multifamily and commercial assets, and has built over $110 million in real estate through his construction and development arm. Shane, we truly appreciate you coming on the show today. If you could, just let everyone else know a little bit more about yourself.
Thanks, Josh. Appreciate it. Yeah, my pleasure to be here. Great to be on your program. So, I live in New Hampshire. I've got a wife and 3 kids, and love being outside, love being active, love the active lifestyle, boating and hiking, and just enjoy nature in general. And obviously, I love real estate. This is all I do. This is all I've done for most of my career, and I'm extremely passionate about it.
Awesome. So we've got a lot of different changes this year, of course, from last year, and then there's probably going to be more changes into next year. With this time, why is a dedicated asset manager critical to the success in this new environment?
Yeah. So good question. We believe that, one of the things that we're intending on bringing in-house here over the next 12 months is property management. And so prior to that, and one of the things that's leading us to that is not because we feel like it's a profit center, but it's really just a control mechanism. And so to tie into your question, the critical part is that I think a lot of folks who have assets make the mistake is that they rely on their property manager to manage the asset the way they would want it managed, right? And so for us, that starts with culture. This is a people business at the end of the day. And at the property level and at every level, we're talking about people. We're talking about residents, their homes, and we're talking about the staff that runs the assets. And so the culture, you're basically hiring out a third-party culture to manage your asset. And does that necessarily align with your company culture, your vision, et cetera? Furthermore, most third-party management companies that we've found and seen, they don't necessarily manage the asset from an ownership mentality. And it's very different to run a property management company as a for-profit business versus an ownership mentality at an asset. And so we very, very tightly manage our assets and have dedicated asset managers that are watching daily KPIs and really engaging with the local, with the property level staff, not just necessarily the regionals.
That's huge, and instilling a sense of urgency when you've got units that are down and getting those leased back up in a timely manner.
Yeah, that's right.
And like you said, conveying the message from top down, that message can get broken up in a lot of different ways when it's going outside of your organization. I totally agree.
That's right.
Perfect. What are your top strategies when identifying a market or an asset to buy?
So we've identified the major MSA markets that we believe in, and it's really just 4 states. It's just Texas, North Carolina, South Carolina, Florida. And the reason we identified those is simply due to population dynamics, right? Where are people moving? Where have they been moving? But more importantly, where do we expect population growth to occur over the next 5 to 10 years, which is generally the business life cycle for most of our acquisitions and assets. And that really leads to discussion. Then from there, we've identified the major MSAs within those markets that we believe in. And mostly that's due to liquidity, right? So there's always going to be assets trading regardless of macro environments and macro conditions. And so in major MSAs, million plus populations, et cetera, there's just more inventory and there's more opportunity to buy in and to sell your assets at any given time. So we believe in that. The next layer down is really one of our company kind of slogans or taglines is we buy neighborhoods first and assets second, meaning we drill into the MSAs and really get to the neighborhood level data that shows, within, we just bought an asset in Dallas, right? And so is Dallas a great place to buy multifamily? Sure, absolutely it is. Is every neighborhood an intelligent place to buy an asset in Dallas? Absolutely not, right? So you need to be careful with where you're buying. And so we do that next level analysis and get very granular on that neighborhood level. We look at the 1 mile, 3 mile, and we really ensure that we have positive population growth trends. We have median household incomes that are above the averages. We have lower crime rates in general. And those are some of the main, main characteristics that we look at before we'll even look at a T12 and rent roll and analyze an asset. We want to make sure that we're buying in neighborhoods that are heading in a positive trajectory for the life cycle of our ownership.
Got it. Are you all focusing on primary or secondary? I don't think tertiary with the population, but is it one of those two?
Yeah, no, we're definitely only interested in the primary markets.
Got it. Okay, cool.
Absolutely. Yeah.
All right. What are the top metrics that you use when analyzing an asset?
In analyzing it relative to acquisition when we're going to buy it?
Yeah, like just what are the key things that you look at to determine the next step? Like besides population, are you looking for of course you said crime rates, you're looking for population. What about the asset itself though? Is there a certain unit mix, unit count?
Gotcha. Yeah. Okay. So right. Once we determine that we have the right neighborhood, we have the right demographics, then we're analyzing the asset itself. We really only buy 150 plus units. Most of our acquisitions have actually been well over 250 units. But that's really our kind of baseline threshold. They have to be over, 150 to 200 units in size. And that just really is a function of getting us to scale, getting our acquisition goals aligned. And also coupling that with the sizes of equity checks that we like to get from JV equity, from institutional capital, from family office groups. Most of those groups, they won't even look at anything unless it's a minimum $5 million check size. And then we're obviously, we want to be in assets where there's an economy of scale, where we have buying power, where we have, intelligent staffing ratios as well. And so we're not necessarily relying upon one or two individuals at any given time in an asset. From there, we really look at, a few important things. Number one is how are we acquiring that asset? Is it off market? Is it on market? We really appreciate and spend a lot of time with our broker relationships. I think broker relationships are critical. I think they're going to become even more critical as we move forward further into this cycle. And really maintaining those relationships and maintaining keeping them up to date with what you're doing and what you look like, and vice versa, sort of requesting information on what they're seeing in the markets that you're interested in is really important. And we spend a lot of time doing that.
Gotcha.
The next part of the story we really look at is, do we have a good basis? Are we acquiring this asset at a good basis? I feel like over the last 2 years, there haven't been too many stories where you could say, hey, we really got this at a good basis relative to, history or to necessarily, what's going on in the market. And we feel like, as we move forward into 23, that there are going to be more and more opportunities to acquire assets at a very good basis, simply due to the capital market conditions, what we believe to be a short-term rise in cap rates, and pricing reduction that's occurring. And so, now is potentially a really good time, if you're careful and diligent, to acquire assets at a really good basis, right? The number one rule in real estate, this is going back, probably 15 years ago. I think one of my mentors said, you make your money when you buy, right? You realize your returns when you sell, but you ensure the success of your project and when you buy it, how you buy, and the basis that you buy at. So that's critical. And then obviously the other thing we really look at is most of our assets are value add opportunities. And so we're constantly looking at the comp set, and we want to make sure that we're buying assets that are at the lower tier of the comp set relative to average effective rent. so that we know there's a clear story in terms of how we can raise rents via a value add program. If there's a loss to lease burn off, we love those stories as well. It's potentially a sign of mismanagement or not the most diligent management that could be done at an asset. And the reason we require that is because we never want to be the market leader in rent in any asset that we buy. So we take a look at who is the market leader in rents, who's setting that bar, and we always make sure that when we're underwriting that we're coming in under what the market leaders are already doing. That way we know we have a cushion, we know we're safe, and we know that even if things go down a bit, we're still under where they're currently riding and pushing the market to. So we like to be in that sort of 75th to 80th percentile of the market. And we like to buy assets that are, currently closer to the 25th percentile, right? And that's where we're fundamentally adding value and raising that, having that revenue growth build and having that NOI growth.
That's perfect. You said a very, very key point is you make your money on the buy. And I know that the entire, I was going to say this year and last year was buying based on pro forma and buying at a future what if value. And I know that's softening up, speaking with some owners and brokers, but I think that there's still a strong feeling from owners that they can still can achieve a premium for their complex. And I think it's going to take a little bit longer for that to wear off, maybe first, second quarter of next year. And then, like you'd said, there's going to be some real opportunities. Buying at a sub 4 and 3 cap on a what if future value. There's going to be, I think, some hard learning lessons coming up here as well.
Yeah, I agree, Josh.
Unfortunately. So benefits of multifamily investing for passive investors. I know it's massive, and if I could just have you elaborate on that.
Sure. Yeah, I'll lay out a couple of the principles that I think are intelligent for passive investing. The number one, I would say, is leverage. The principle of leverage, right? So if you go and you buy, I don't know, let's say, a typical stock or equity, like let's say you buy Apple stock, right? And I don't know what it's trading for, but let's say it's, $100 a share. You take $100 or you take $1,000 and you buy 10 shares of Apple. That's a 1-to-1 ratio, right? It took the exact dollar amount that you have to buy the exact share in that equity that you're purchasing. And so as that equity hopefully rises in value, you're sort of in a 1-to-1 relationship with your capital and the growth of it. Whereas in real estate, we use leverage, right? Historically, perhaps up to even 75% leverage. Currently, you're probably more like in the 55 to 65% leverage range, but still leverage is key because you're using bank debt and you're using low interest bank debt to acquire an asset. And so you fundamentally are growing your money faster because of the principle of leverage. The second one is obviously pooling your money with other people, right? With my money, with your money, we all pool our money together. We all get to buy assets that we likely couldn't acquire on our own, and there are inherent benefits in that, namely scale. And with the scale, you have the benefit of larger assets are, look, if you only have enough money to go buy a duplex, right, or a fourplex, and you buy it yourself, and then in that duplex you have a vacancy and somebody moves out and it takes you 3-4 months to fill it up, well, you're now 50% vacant, right? Whereas in a 200 unit asset, you have somebody move out, well, it doesn't even move the needle, right? You can't, it doesn't matter. And you have that, if it takes 3 months to fill the unit back up, which by the way, it never should, but let's say it does, it really isn't affecting your operations. It isn't affecting your cash flow that much. And so there's benefit and safety in that scale when you're passive investing. And then I guess tied in with that would be, the passive investing principle of, you don't have to necessarily worry about that. You're not worrying about tenants trashing toilets, right? You sleep soundly at night. You're not fielding those calls. Whereas if you go out and buy a duplex, quadplex, et cetera, that's active investing. And I don't want to discourage anyone who's interested in doing that. That's certainly how I started. started, and organically grew my holdings and myself to be able to do what we do today. But maybe that's not in everyone's best interest. Maybe that's not what you want to do. And maybe having a 2x equity multiple on your money without having to do really anything other than, check your quarterly updates, and have that money grow for you passively is extremely valuable and extremely important.
Yeah, totally agree. I think having something to where you can actually drive out and go touch it, and that your cash is in bricks versus in a like you brought the stock market versus a stock at a company where you're relying on them to perform, and you're hoping the market conditions will stay in place for your dollars to make more money to come back. It's real estate. You can feel it, touch it. It's historically it's going to go up in value. It's just, I think it's a sense of a peace as well.
Yeah, without question. And it's got tremendous resiliency in the face of, economic downturns, right? Even if you look back to 08, 09, the largest depression or recession that we've had sort of in our lifetimes. And multifamily housing was extremely resilient. Most assets really, didn't drop below 85% occupied. And most of them were able to cash flow. Certainly everything I owned during that time period was just fine. Granted, it was smaller and I self-managed, but needless to say, if you just held on through that time period, then you did fine, and everything was fine. If you needed to sell or had to sell, that's when you get in trouble. And so there's nothing that's going to replace housing. It's evergreen. It will always be there. Will always be a need. It's been there for thousands of years. It will be there in thousands of years from now. Whereas stocks, bonds, companies, et cetera, those are a bit more fickle. And so, I agree with you 100%. Real estate is a great hedge and a great risk-adjusted return.
Yeah, and to add on to the housing will never go away. I know 2020 COVID, I think solidified the people working at home scenario, and that's where you get these major hedge funds that are really putting a lot out there on buying houses. Because reading a report, the work at home is not going away. People are going to be working at home more and more, and these hedge funds know that. That's why they want to buy more and more real estate. And essentially, the house is turning into the office space, and the office space asset class will never be the same. It just it won't. I'm in my office right now. We've got 15,000 square feet, and it'll never be what it was before, because you can have a hybrid approach. So multifamily real estate is truly, in my opinion, one of the safest investments that you can have out there right now, and I think moving into the future, for sure.
Absolutely.
Got one more question for you, Shane. What are the things you're looking for with your investments going into 2023?
So, again, what we're looking for is we're being cautious. We're being careful with what we go after. It has to check all those boxes that I mentioned prior. It has to be in a major MSA. It has to be in one of the better neighborhoods within that MSA. It has to have positive population growth trajectory, solid household income, relatively sound crime data to it. Has to have a way we can fundamentally add value, not just expect or hope or wish that there's going to be organic rent growth, especially double digits that we've seen. I don't think anybody's expecting that anymore, but we, one of our metrics, I didn't mention this, but one of our metrics for value add is that we need to fundamentally increase net operating income by 50% in 3 years. That's a kind of our back of the napkin math. If we can do that, then we know that we are creating value at the property, and that regardless of macroeconomic conditions, we have fundamentally created value, and our investment is sound, and our investors' capital is safe and secured. And so that's one of the driving metrics that we analyze when we look at an opportunity is, can we do that? Is that reasonable? Is that achievable? Both from an execution standpoint and from a comparable rent or comp analysis standpoint. And then, again, I think that the basis story really can't be understated. especially in this market, we are really paying attention to our going in basis and ensuring that we are utilizing in-place debt whenever possible. That is a fixed, potentially lower than the market rate debt. We're looking at opportunities where the seller can perhaps carry back some, and really create a scenario where we are creating safety for ourselves and our investors in the asset. But you really can't beat the basis play. So if you're buying in a high interest rate environment, right, which is where we are, and which is where 2023 will be for most, probably the entire year until it stabilizes, and perhaps at the end, Chairman Powell maybe lowers interest rates a bit, right, but it won't be extreme. We're going to stay in an elevated interest rate environment for the next 12 months. But if you are capitalizing on folks who have debt expiring, rate caps expiring, business plans where they have to exit, and you can pick those up at a basis that's intelligent, given the capital market conditions today, and then you hold the asset and you look to sell it in 3, 4, 5, 6, 7 years from now, when we're in a different environment where cap rates will have presumably come back down, maybe not dramatically, but they will have come back down from when you bought it, and you couple that with a value add strategy, you're talking about a very compelling risk-adjusted return metric now.
That's huge. And you gave some very good nuggets there for anyone that's listening. Let's write it down. The 50% based on in-place NOI and boosting it up. So are you looking for adding different services like valet trash or different amenities to the complex to help boost up, let's say, gross rents?
Yeah, good question. We always look, we do our baseline analysis just on the rent, right? Just on the base level rent. And can we achieve what we want to do with that? We don't necessarily rely upon all the other income line items and rubs and sort of those secondary, tertiary value add strategies, but we absolutely look to employ them at every asset, right? We look very closely at rubs. We make sure that we're in the right marketplace. We utilize services that keep us in the right level, especially that's something we can identify at the at the pre-offer stage when we're analyzing opportunities. Is where is there other income? Where are the rubs program? Where are they missing the mark on some of these things? Whether it's covered parking or adding small yards or adding washer and dryers. Where can we really boost the other income line items at that asset? We always look at that, but it's not our primary focus. Those are sort of secondary, tertiary, additive gains to our business model, but not the primary. But one of the primary things we always look at too is the exteriors and the amenities, and can we really create a better environment at the asset, a better resident experience? Because at the end of the day, we are renovating and owning people's homes, and we take that very seriously, and we truly try to create environments at every asset where we're making the property a better place to live, safer, cleaner, nicer, and better amenities.
That's perfect. That is phenomenal. I've got one more bonus question for anyone that's looking to break into multifamily or any other real estate asset class. How would you recommend them to start on their journey down real estate?
Yeah, wow, good question, Josh. I would say to really first ask yourself, which path you want to be on. Do you want to be on the active side, and do you want to go down the road of actively managing, actively dealing with the day-to-day, dealing with the construction, dealing with the tenants, and dealing with the myriad challenges and issues that we have in owning and managing assets? Or do you want to go down the passive road? There's no right or wrong answer, right? That's an individual choice for every person. And then from there, if you're going to go the active road, I guess my background is probably skewing my response to this one, but I started small, right? I started buying a 4-unit, and then a 6-unit, and then an 8-unit, and a 20-unit, and really kind of organically grew my holdings and learned the business small and sort of self-managed, and got to learn the business at the ground level that way. And to me, that worked and that made sense. It was a longer path for sure. But this, multifamily and real estate it's not a get rich quick thing. It's a get wealthy slow scheme. And so you really have to have that longevity in mind. You really need to be thinking 10, 20 years of doing this if you're passionate about it on the active side. On the passive side, I would say, first of all, definitely have a certain portion of your investable holdings in real estate because of all of the myriad of benefits that we discussed earlier, especially relative to equities. Now, I'm not saying you don't need to be like me and have all your money in real estate, right? But a certain percentage, and that's going to be different for each person and their age and their risk tolerance. But certainly a certain percentage of it would be intelligent. And then from there, really do your due diligence, vet the sponsor. The institutional capital that we work with and retail investors that we work with, they're wise to know that the operator and the people that you're doing business with are more important than the asset or the opportunity that's in front of you. So really get to know the sponsor, get to know the operator, get to know the good, the bad, the ugly. They should have all three of those to share with you. I know I do. And they should be able to really transparently and honestly lead you down the path of intelligent investing passively in real estate.
That's perfect. That's perfect. I definitely appreciate it. And Shane, we truly appreciate your time today. If someone wants to get a hold of you to find out more about your company and hopefully work with you, how can they get a hold of you?
Sure. Yeah. Appreciate it. Absolutely. Always looking to connect with good people on, Facebook, LinkedIn. You can find me, Shane Carter NH on LinkedIn. Our website is www.hampshire.capital. Happy to have people reach out to us that way as well. We have just finished putting the finishing touches on our ebook, and that'll be up on our website here in the next month or so, and that'll hopefully be a lot more detailed information as well for folks to read into about who we are, what we do, and what our investment thesis is.
Perfect. And then I'll make sure to have your contact information when we send this out as well for everybody to get a hold of you. And again, Shane, we truly appreciate your time, your experience. It's true wealth. We'll definitely be talking soon.
All right. Appreciate it, Josh. Thank you.
All right. Thanks, Shane. Yes, sir.
All right.